Good evening, everyone. Thanks for joining us this evening. I think we've got, I see a lot of UK clients, but clients from all over the world, and appreciate it's a hot evening. And you might be, rather out having a beer in the beer garden somewhere. But thank you for joining us with a slightly different format. We do these sort of end of year and mid-year updates, and we do regular sort of global webinars to our different audiences weekly. And we found the most sort of valuable bit, or the bit that people were telling us they get the most out of, is like a Q and a question and answer session. So we thought we'd really not pitch any particular developments or talk about any particular properties or areas, but just talk about the market in general and just make it more educational and more informative. And there will be on the screen there, it seems to change, but on my screen, you should be able to, you'll see either a little Q&A box or the little more box. And if you click on the more box, you can ask questions. So I'll introduce you to the panel in a second, but if you can, any questions to do with anything property, we should be able to answer for you. And I've got some experts, which I'll introduce now. So if you can, I've got some questions that people have sent in already and some existing clients, but let's make it nice and interactive. Give us some questions and then we can hopefully make it nice and interactive and cover off any topic property related. If I could have the next slide, please. Thank you. So I'll introduce you in a second, or we'll come onto the screen. We'll have Faye Adams. Faye we've been working with for many years. So an important element is leveraging, is borrowing, is mortgages. So Faye's a specialist for both UK and overseas clients. Probably 90% of our clients are mortgaging. So it's an important element and a good way to leverage, good way to borrow, good debt. I always say mortgages. So Faye will be on the panel, and then I've got Raj Bedi from Martin & Co. Our UK head office is in Birmingham. Raj is in Birmingham, and Martin & Co. are a UK franchise. So Raj has a sort of we've been working with you, Raj, for about 10, 15 years, I think now, in Birmingham and other regions under the Martin & Co. franchise. So anything to do with lettings, mortgages, tax, whatever. I think between us, we're all serial investors ourselves, of course. So I'm sure we'll be able to help and advise as we run through. Can I have the next slide, please, Han? What I wanted to do is just literally, I can see we've got a lot of new investors or new clients on. So thanks for joining us. And I just wanted to give really a little bit of background as to us. And the company was started by Andy Foote, gentleman on your left there, 2001, serial property investor. And when he started getting into property and selling property, he had an experience of buying property overseas. Still got that property today, very profitable, but the level of service and the support, whether you're local, national, or international, we find 99% of our clients, we do all the work with them or for them, and I'll come on to what that means. But we're there, we're geared up to look after investors. We've got investors from all over the world. Some have never even been to the UK. They just know the UK is the most invested property market in the world for obvious reasons, which I'm sure will come up as we run through the Q&A. So when he started the business, it's built on the bedrock of customer services. We've probably got in the UK and Europe 5 or 6 salespeople, but 20 people in the delivery and the customer care and the after sales. So that element is super important. Next slide, please, Han. We've delivered more than this now, but we've delivered minimum of 4,270 units marketed. That's the easy bit. Sold. That's pretty straightforward, but more importantly, delivered successfully. And we have a lot of clients, might not sound a lot, 28% of clients repeat purchase. That's where people are building a portfolio. Having said that, I think it's about 63% of our clients might have 1 or 2 properties, and that's it. So yes, we've got investors that might have whole blocks or hundreds of apartments from us, but we're geared up, and the bulk of our investors are first timers and need that help and support which we provide. And we've delivered over 45, that's those 4,270 units are across about 45, 46 developments now. So we partner with developers. And we've delivered, again, over £500 million with GDV, gross development value. So that's the value of the apartments that we've delivered to date. If I could have the next slide, Han. Thank you. Again, talking about what Andy went through and the customer sales side, if you see something you like, you'll reserve it, you'll get to exchange. We have developments that are ready. We have developments that are off plan. We have some that are a year away. So there's different models there. We get you to exchange and then we get you to completion when the thing's ready. But there's a lot going on with customer care in the meantime, mortgages, as we'll see, lettings, furnishings, solicitors. And that's kind of as we get to handover, we get you completed. Then there's after sales. And we 2-year warranty on the development and the build, and you've got 10-year build warranty. So, like it or not, we're with you for the long haul. We're not an agent; we're a promoter. And I'll come on to what that means in a minute. But if you want us to be, and most clients do, we're with you for the long haul, just making sure you get the best customer experience and the best out of your investment. Next slide, please. What does that mean? Property promoter. We partner with developers predominantly on an exclusive basis because they love us, because we're doing all that customer care and they can just get on and finance it and build it. You love us because we do all the customer care side of things. And we do more. It's really important. We do things like 12 monthly portfolio reviews. We'll come on to why that's important, particularly with the new Renters Reform Act in the UK and how you can benefit from those reviews. And we help, and people like Raj from Martin Co will help with sort of rental appraisals. And there are ways of, I think we probably all know, particularly in the UK, on average, property prices have doubled and expected to carry on to double every 10 to 12 years. And we all should know that the rental market is super strong. But by doing a little bit more research, we tend to work in the areas that are going to give the best capital appreciation and the best rental returns. Because when you're talking about a couple £100,000, if we can get you 1% more on the rent, we can get you 1% better capital appreciation, it really does affect your pocket. And at the end of the day, for me, it's all about the maths. And we do have what I call detailed cash flow summaries, so we can make sure and we can demonstrate to you in today's world, today's interest rate, you're cash flow positive from day one. Next slide, Han. This is just a reminder there for any questions. Please put them in the chat box there for the panel, and I'll kick those off in a minute. And have we got the next slide, Han? Lovely. Okay, so that's enough PowerPoint and slides. If I can get Raj and Faye back on. And then, as I say, keep the questions coming. There's some that we've had in earlier, and I'm sure we'll get some as they come up, working from a few different feeds here. First one I can see, well, for me anyway, for you two guys, is the first half of the year has been surprising in some areas. Keep it vague. What's your single biggest takeaway so far this year? Maybe what sort of surprised you really in the first half of the year? I'll throw to you, Faye, first on the mortgages side of things.
Yeah, so actually, really interesting that we've had the first AI valuations. So we've had a bank that are trying,
Really?
yeah, they're trying out the first AI, but that kind of scares you sometimes because I've tried to see if AI is going to take over my job and they've got a lot of things wrong. So I'm okay there and I feel safe. So do I think, it'll work? But what they've said is they're doing the AI valuations and then a risk surveyor is reviewing it and just checking it off a human. But what he's doing is actually speeding up the process and less room for errors. So we're trialing that out at the moment, so it's really good. It's only available to UK residents at the moment. They're not doing it for the overseas, but it will come. It's just being trialed. So I just thought that was interesting how property, has been the same for so many years. It's always good, but to see tech coming in now and taking
Yeah.
part.
Well, I suppose we see, obviously, because with what we've delivered, we've got a lot of stuff off plan, but obviously we've had many units that have completed, and that sort of manpower, everyone still blames COVID, I think, don't they? It's just because they haven't bothered restaffing,
Yeah.
And I suppose if they can take a lot of the work away, that could help. Because sometimes hope we've got no surveyors on, but they can be you
Yeah.
can get differences of opinion. Let's say that.
Yeah, definitely, different firms, but obviously that will take a lot of it away. So it was really interesting. So it's come on now, so we can start doing them. So I will definitely be trialing them when a suitable candidate comes along with for that lender.
Do we know if it's been sort of successful, the AI valuation?
Yeah, they've said it's been very successful, and it's you're speeding up the process. So yeah, I'm interested. Not tried it yet, but it's good that I know it's been happening all the start of this year, and now it's been launched. So yeah, be interested, and I'll keep you updated on that one.
Yeah, it's going to take over the world, isn't it? It's
Yeah, yeah.
I think it can be a little bit scary, but then maybe that's just my age.
Yeah, I just like that there's a risk surveyor at the end of it, a human reviewing it as well. So we've got the best of both worlds and it can speed it up. So, more human errors, I suppose, but it's the best of both worlds, isn't it? So yeah, be interesting.
Yeah, cool. I was quite happy with pen, paper, letter, and a fax machine back in my day.
Yeah.
Just show me age. Raj, as I say, we've been working with Raj for decades. Tell me what your sort of key takeaways are, and your maybe think something that surprised you in the first half of the year.
Obviously, the big thing for us in lettings has been the Renters' Rights Act. Probably what surprised me is actually it's not as bad as people think it is for landlords. That there's a lot of talk about how, it's all anti-landlord. And yes, okay, it is very kind of, geared up towards the tenant. But to be honest, a lot of it, if it, it's not such a bad thing for landlords. It's not had that much of a negative impact as people maybe necessarily thought it would. Because ultimately, if you're a landlord, as long as you look after your properties and look after your tenants, you haven't really got an issue. So it's only really the rogue landlords that aren't dealing with maintenance issues that have got the issue. So, and really, it's probably right that we don't really want them type of landlords in the market anyway.
Yeah, I just looking up actually, I probably should have prepared this before, but I had something before about we had some sort of numbers and bits and bobs, didn't we, on the how things have arguably got better really in terms of I think there's less landlords in the market. Are you seeing sort of landlords exiting?
Yeah, so we're finding that they're kind of like the accidental landlords who, maybe they,
Inherited or something.
yeah, or maybe they didn't sell their home and they moved and then rented out their home and, kind of fell into being a landlord. Some of them are exiting and now selling their properties. And yeah, we're finding it's kind of more, the professional landlord that sees it as more like a running a business and maybe they've got, more than one property and, them types of landlords are more kind of dominating the market.
Yeah, I think it's getting more sort of more professional, really, isn't it? I've got something here from some research. Supply down 18%, demand far outstrips supply. You can charge higher, more stable rents. There does seem to be, again, I know it's only new in, and I know you're a big landlord, and I'm a big landlord as well. It doesn't seem to be no dramas, no issues. In fact, I think because there's less rental property out there, the demand is sky high for reasons which I'm sure we'll touch on. Supply is super limited, so it's only pushing the rents up.
Yeah, absolutely. So obviously we saw kind of 6 years ago after COVID, the rents skyrocketed and they have really continued to do that. But they probably over the last couple of years, they probably, they've gone up, but not as dramatic as they once did, which is, to be honest, good because it was unsustainable. We had at one point rents increasing by 100, £200 every year, and that just was never ever going to be sustainable. Whereas now they are increasing, but at a more sustainable rate. Which I actually think that's better because you don't want tenants to fall into arrears. You want people to be able to afford the properties. So yeah, good news is rent's still on the up, but just at a more sustainable rate.
And I think it's quite good because there's a cap, isn't there, on what you can put the rents up. It's 10%, isn't it, per annum?
No, so it's actually based on market rent. I believe I'm not aware of. Obviously, there's a new, obviously the new law that you can only increase every 12 months. But I'm not actually aware of any cap. As far as I'm aware, it's just market rent basically.
Okay.
Um, so yeah, you get you and the landlord and the tenant agree the new rent. The tenant has got a right to challenge it, and if they challenge it, it goes to kind of like a rent officer that works within the government, and then they see whether it's a fair rent or not. So, not such a bad thing, probably a good thing that, landlords, they can't, they're less going to be likely to increase the rent beyond the market rent, and which isn't really fair anyway. So,
Yeah, it's early days, but I don't suppose has any of these sort of tribunals or anything. I'm sure nothing's happened, has it?
we've not had it yet, but to be honest, that tribunal has been around for like since I can remember. It's always been there. It just hasn't been uh, well known, really. People didn't really know about it, whereas it's probably a bit more well known now. But obviously, we're adapting to this new process for the last
Yeah,
couple of months where we're increasing the rents, and all we're doing is justifying it and showing comparables so that tenants are understanding and therefore not thinking, right, I'll go to the tribunal, because they know, we've justified it, so
mm,
they kind of
yeah.
can't.
And
Uh,
I suppose it's good. Most people will work with an agent like yourself, so it's good to get that pricing right, isn't it, from the word go? Make sure you've got it priced according. I've had stuff, and I've had good tenants in, and I've never put the rent. I'm quite a soft landlord. They're nice people. They're paying the bills. I've had stuff where people have left pre-renters reform act, and I've got 450 quid a month more over where they've been in 4 or 5 years rent. So it's important to be on top of that. And that's why we do reviews. And obviously you'll do the same just to make sure. Because at the end of the day, it's maths, isn't it? We want the best capital appreciation, we want the best rental yield. So we've got to manage the spreadsheets and the math side of things.
yeah.
Cool. We've got developments predominantly. We've got some in the south, but predominantly Midlands and North. And I've got, maybe this is a question for me. Are we seeing a sort of two-speed market? Areas like here, someone said like the northwest or the north. Are we seeing slower growth and inexpensive areas? And I'd say, yeah, as a sort of case of point, probably look at London. Average rental yields in London, average property price is like 670,000. Average rental yield is 3%. So doesn't really work for an investment. I think if you're an overseas investor, you look at London and think, yeah, if I'm thinking America, I'm thinking New York. If I'm thinking Australia, I'm thinking Sydney. But you've got to think beyond like where we are, Raj, in the Birminghams, and we've got areas that are giving you much better capital appreciation, much lower price point, less stamp duty, and percentage higher yields. Are you seeing that in your regions and your sort of markets, Raj?
Yeah, so obviously market wise, we're finding that the market is quite steady. Obviously the kind of the cheaper the area, the better the yield, and the kind of more expensive the area, the lower the yield. But then people that buy in kind of the more affluent areas, they're buying more for the capital growth, and they're not so bothered about the yield. So yeah, but generally we're finding that, yeah, the sales market's quite good as well. It's not probably what it, the how good it was a few years back, but it's still, decent enough.
Yeah, and again, there'll be, for people that want to talk to us from a sales or a mortgage or lettings point of view, there'll be a little box to tick, so we'll be in touch with you later on in the week. But we've got developments, we've got a student accommodation, which won't give the best capital appreciation, probably 1 or 2% a year. However, 7.5% net guaranteed return. We've got other stuff probably from the 150 mark, which will give you maybe higher capital appreciation, slightly less yield. And there's some other stuff which will give you a mix of both, really, you know? So it's a case of which we do. We have a research team, but we're a research person, but we do leverage on your Knight Franks, your JLL, your Savills that spend millions on research, looking at the best areas to invest in the UK. You've got your Birminghams, your Manchesters, your Leeds, and certain key areas where you're getting, better returns. So we just want to be a little bit cleverer there as well. Cool. Let's get Faye on. Let's talk a little bit about mortgages, Faye. Yeah. What? Tell me, tell me about the interest rates. When are they going to fall? Hopefully tomorrow. What? Give me some information.
I get that asked that every single day when they're going
Yeah.
to fall. And what will they be in 10 years? So at the moment, it's positive. It really has been up and down, but nothing too drastic. So it's been since Liz Truss, the lettuce outlasted her and the rates went up and we saw a bit of a change in the market there. And finally, they're coming down to what normal levels. We had a bit of a blip with the Iran war. Obviously, oil prices going up, swap rates going up, which drove rates up slightly. And now they're coming down. Now the thing is, that it wasn't a long blip because the war was only a couple of months. People hadn't completed on the mortgages, and now when the rates start to come down, we can switch them. So as long as they've not completed, we can switch them. So although they were there to be quoted and to apply with, we are now switching the rates as they're starting to come back down. So it's almost like a worst case scenario, but people probably saw the rate and thought it was a bit high, but actually it's come down now and we've managed to switch it. So, things can impact rates, elections, wars, COVID, everything that these things can impact, but it is looking positive. We're not inflation is getting better. We've got a base rate review on the 30th of July. I'm not sure yet whether they'll hold or come down. I think it's a bit of a 50-50 at the moment.
Hmm.
But when that day happens, when the base rate happens, if it holds the same or it goes up, my phone is silent. If that comes down, my phone is the rates come down and the rates come down. So the base rate does not control the fixed rates.
Yes.
That's a big lesson. So when people think, oh, well, the base rate's 3.5, how come my rate is 4, which should be 3.5? It's not that. It's what the banks leverage their money at and buy their money at the swap rates. So what it does is if the base rate does fall, it does have a positive impact, but it's not going to say, right, if it drops by 0.25, every single rate drops by 0.25. So I do get it's very busy on that day. But likewise, again, as an example, if the base rate, let's say, 3 or 4%, we've got rates at the moment that are 2.7. And people say, well, how can they do 2.7 when the base rate, it just shows you it's nothing to do with the base rate. So yeah, we've got some really, really good rates coming on the market and some really good products. A lot of lenders, I think, because of the rates that they were up for a bit, they're playing catch up. They have targets. They're coming into the market, things that they never would have done before. They're starting, we've seen people do, some like assisted living, and kind of like two offers in one, like flips, where they buy a property and then flip it. They're actually giving you two mortgage offers and saying, well, if you do what you say you're going to do, we'll give you an offer and offer that loan amount. So it's really adapting things that are just making it easier for landlords and just easier just for mortgage borrowers all around.
Brilliant. So at the moment, as of today, you can get rates for 2.7% buy to let mortgage,
Yeah.
75% loan to value.
Yeah, because that will everything you just said there affects it, whether it's a 2-year fixed, a 5-year fixed loan to values. So yeah, that is a 2-year fixed on a 75% loan to value buy to let to limited companies to personal. That one does mean you have to own a property already, whether it be your home or another buy to let, just own one. So each lender does have qualification criteria because obviously if one lender could lend to everybody, then we'd only have one lender and we'd have the cheapest product. But there's around, well, it's about 8,000 products on the market. So it shows you they're all in different fields and areas. And it's very rare, we can't get somebody a mortgage. But that is the cheapest rate as of today, yeah.
Brilliant. That's really good. And again, Mike, is there anything caveats if it's like if you're investing in a limited company or ages? I remember you saying it doesn't really matter how old you are because they'll look at the rental income, the rental yield.
Yeah, again, it depends on the lender. So some lenders might say, right, we only want to take somebody up to the age of 85. Some, like Cambridge Building Society, just no upper age, you just keep going. People say, oh, I'm too old to invest, and it might be 75. You're not. You're absolutely fine. It's just finding that suitable lender for you. And the limited company aspect, everyone thinks that buying a limited company is more expensive. It's not. What they're probably seeing is, let's say your high street banks, everybody will know your HSBC, your NatWest. They don't lend to limited companies. They don't need to. They've got a huge book. They don't need to open up. I
Hmm.
think maybe one day they will, but at this time they're not there. So if you've got buy to let in a personal name that NatWest is offering, and then we've got a limited company lender, then those rates aren't available in a limited company. So they probably think, well, I've just lost that cheaper rate with NatWest, thinking that the rates are cheaper in a personal name, but it's not. It's just what the lender is offering at that time. So if a lender lends to limited companies, they lend to personal, and 9 times out of 10, they're exactly the same rate.
Perfect. I remember back in the day, maybe my granddad told me, like 15% rates,
I know.
15% mortgage rates. Wasn't for long, but hey, my dad, who's 93, was still buying stuff at the time. Still got those properties. It's holding things for the long haul. Last I did a buy to let. I like borrowing. I'm very sort of mortgaged or leveraged up. The best rate I could get at the time was seven. This is only 2 years ago. 7.09%. I did a 2 year fix, and I was probably, I'd be lying if I said I was breaking even, probably underwater 100 quid a month. However, I knew what I was buying. I bought off plan earlier on. That property has gone up 25 grand. So I looked upon that, paying it 100 quid a month. I looked upon it as my pension scheme. So that whatever I put in, 22,500 over the 2 year period, it's cost me. I've made 30,000 on the property, and I did a 2 year deal, April 26th. I remortgaged, and I got a rate of about 3.99, and now cash flow, very much cash flow positive, and I've got even more equity in it. So easy to say, but it's a case of being brave, really, isn't it? Because we all know, as I say, property prices double, and again, we've got all the reports and everything where the future's good in terms of rental yields and sort of capital appreciation. So you've got to look at the bigger picture. But having said that, with a rate of that 2.7 or whatever it was, fantastic. That makes a huge difference, doesn't it, to
Yeah.
your monthly cash flow?
Yeah, it does. Yeah, it's really good.
Good. Okay. Might be one for Raj because I know in Birmingham, and Manchester and other areas that we're developing and working in, how do regeneration projects like, HS2 in Birmingham, massive regeneration projects, what does that do? What have you seen that do to the market, Raj? Probably 2016, I guess, that regeneration started, and it's going on now, and there's still a long way to go.
Yeah, so although HS2 isn't here yet, it's obviously had a massive impact, obviously on the sales market because people are wanting to invest in Birmingham because they think, right, I'll buy now before HS2 is here because when it's here, obviously the prices are going to go up a lot. Whereas on the rental market, obviously it's not benefited directly from HS2, but it's also, with what's going on with HS2, it's meant companies are relocating here. So that's created more jobs. You've had an influx of people moving into Birmingham and the city centre, and obviously you've got a lot of people that were working for HS2, so they're a massive employer in Birmingham. So and it's not just about HS2 as well; it's about what other kind of projects support it. So obviously you've got all the new metro system, which is kind of piggybacked off the back of HS2, and that's obviously got people working on the infrastructure or people thinking ahead of where they want to live and being accessible to certain places. I think regeneration has had a massive impact, especially in terms of the amount of key employers that have moved to Birmingham in the last you know 5 years or so.
Yeah, I think there's, we're a growing population. I did read somewhere the other day, 40% of people in the UK are single. Um, so of course we're living longer, and it's for obviously affordability reasons, it's a renting world, isn't it? People always ask me uh, about void periods. Well, we just don't get voids. We'll build something, we'll get them pre-let before we've handed over. So the day we give you the keys, Raj will have a tenant in there for you. It really is that dynamic. And I think you've got that element as well. So it's, generation rent where, we're downloading Spotify with our music, Netflix, cars, these personal purchase contracts. It's just the way the world is really. We're not, well, the youngsters don't necessarily, I think I read it again, half of something like 20 or 25-year-old don't have cars. So again, train, the tram, that work, rest and play, you're working, resting, and out your pubs and bars in the same area. Now, I know a lot of developments in Birmingham, some don't have car parking spaces, and that's a deliberate thing by the government, but they are putting in the infrastructure with the train and the trams. And then you've got Birmingham, Manchester, again, lots of regeneration, lots of companies reallocating, and it just makes a massive difference. We say property, or I say property prices double every 10 years. So you think, well, I can stick a pin in a map and it's going to work well. But again, with a bit of research, a bit of help from someone like us and Raj, and making sure you're getting the best rates, then you're just making the most out of that investment, really. It's super important. And is there, Raj, while I've got you, we used to say 2 beds, 1 bed, studios, 3 beds. Is there any type of property that does the job better than anything else?
I'd say that they're all good. They all have its place. But I would probably say if I had to knuckle it down to what sort of kind of the best, I'd say a 1 or 2 bed. The studios are good for affordability for tenants, but then there's probably a bit less demand because people would rather pay a little bit extra to get a 1 bed. 3 beds, there's less demand for 3 beds, but at the same time there's less available 3 beds. But I think if I had to narrow it down to one, I'd probably say a 1 bed and then followed by a 2 bed.
Yeah, back in the day we'd say 2 beds, but again, because you have people sharing, but now people want to be on their own, they're living on their own. And again, whatever you've got, I mean, we don't do many 3 beds because there might be one in a development of say 50 apartments, but because there's only one, we either sell them to a homeowner or they do rent. But yeah, and obviously with the studio or a 1 bed, it's more affordable. The bills are more affordable. You can buy more of them. I'd rather have a studio and a 1 bed than maybe 1 2 bed, for example. Okay, interesting. Maybe let's Faye, what about if we're doing something off plan and we might not need a mortgage for maybe anything up to 24 months? Can people talk to you to see if they're kind of mortgage ready? How does that work? Because they can't apply for one yet because potentially it's not built.
Yeah. Yeah, so you need to wait for the property. For us to be able to apply, the lender needs to assess you at that time because circumstances can change in 2 years. Assess you at that time and also be able to assess the property. So you can have a chat with us. We can give you peace of mind to say, right, as of today, your criteria is fantastic. Keep it that way. So don't miss any mortgage payments or don't miss any credit. As long as you stay in your role or earn above a certain amount, so on. Everybody's different, and then, like I say, all those products, there is a lender for for everyone. I had some clients today that are not working, no income whatsoever, and we can still remortgage their buy to let to invest further. So, people think, well, what if I lose my job? Not say it doesn't matter, it will to that person, but for mortgages, there will be somebody. There is somebody for everybody. So yeah, you can have a chat with us, can give them peace of mind that as of today, the rates are, obviously we won't know in 2 years. We are anticipating to see positivity now. Now everything's calmed down.
Sure.
But yeah, it gives people an indication of what the market is doing right now, because you might see things online, you might check AI, and it's just not accurate. And also, I mean, just talking to their own brokers, people who've bought their own homes, they've had a broker Nothing against those brokers. They are going to be really good in that field of residential mortgages. The amount of times I've said, well, I've been with my broker and they've quoted me 5 or 6%, and I just don't know. I just don't know how. And
No.
I'm looking and I can show them the evidence and get the decision in principle. I can get you a much, much better rate. But that's where I specialise. I specialise in buy-to-lets, the new builds, the company structures. There's lenders out there that they aren't your high street banks, but they're the regulated banks and so on. And you're protected by the FCA against our advice as well. There's just a whole new world out there, not just your high street.
Yeah, and I think all the developers we work with have assignable contracts. So
Mm.
what does that mean? It means that you've exchanged on 20 or 30% of the purchase price, and then 6 months before completion, you have a nightmare, a partner dies, which has happened, you've lost your job or whatever, then with enough notice, we can resell that unit on. Potentially as well, if you bought off plan, you've had the capital appreciation. We have done it in the past where someone's put their money in, they've got their money back, and they've got the increase because the property's gone up X%. I've done it myself back in the day as a strategy. I wouldn't recommend it now because you exchange, you're at risk, you have to complete on. But it's what I call a get out of jail free card. Should something happen in a year or two, and of course, things do happen. So, but that's where we work with. We're there to help. Any issues that come up, completion or delivery. We do all the snagging on behalf of the developer, etc. So we've got a very strong after sales team and delivery team. So it's important to have the right partner there. What are we saying? How are mortgage rates and product ranges evolving for buy-to-let investors? 75%, 80% loan to value deals, or are we saying typically
Yeah.
75%?
No, it is. I always say 75%. It's better to have more than not. There is a lender that is doing 80% loan to value on new builds now. But again, there's a little policy in there where they don't lend to any properties above 10 floors. Why 10? I don't know. I think they're just, but
Yeah,
that's their policy. So if you have a very, development 26 stories, even if yours was on the third floor, it doesn't. So again, your property, if you said, right, well, I can only put 20% in, and we know that lender's there and they've been really good, competitive rates even at 80%. You could look at a property to make sure that it fits within that policy if that's something that a client really wants.
cool. I've got some more questions, but I've got a nice question here, which might be just a little advert break here. I saw your zero carbon home site mailer. Do you think these properties are good or not? I'm going to say they are good. Um, yeah, we do a lot of apartments and townhouses. We've sort of dabbled with houses in the past, but what's nice about this, it's a strong developer. Our chairman's known their developer for 25, 30 years, well funded, off plan. You put 5% down, then you've got interest-free stage payment terms over the build, and you can choose, there's different phases. So you can have it ready in 1 year's time, phase one, 2 years' time, phase two, 3 years' time, 4 years' time. So you can spread those payments over that period. So that works well depending on your financial situation. And normally with an off plan, you're putting in the whole 20, 25% up front. So that's quite nice. However, yeah, zero carbon. It's an arrangement with Octopus Energy, probably one of the biggest in Europe, certainly the biggest energy provider in the UK, and they guarantee it for 10 years. And why can they do that? The developer puts in the solar panels, heat source pumps, underfloor heating, special energy efficient bricks, and obviously on the double glazing. So it's so energy efficient. It's got an EPC, an energy rating of A, which is the top you can get. So you got all your energy for free, whether you're in it or your tenant is in there. They've got all their energy for free, and Octopus take the surplus energy. So that's what's in it for them. They're making money. You're not paying for your utilities. So yeah, it's nice. And we've got assisted development just round the corner, 15 minutes away from this one, which isn't It's not one of these carbon neutral homes. It's just a kind of normal development. We've delivered those, all rented, all sold, all rented, and this will be the next level. And because it's zero energy, surprise, surprise, the rents are increased, but your tenant is still saving money. You're getting a higher rental yield because they're paying for the privilege of not having bills, but it's still saving the tenant or the owner money. So yeah, again, there'll be a little box you can tick if you want us to contact you later on in the week and run through that in more detail. Freehold, no ground rent, no service charge, and honestly, we've got this energy efficient and a good lots of local businesses, so massive demand there. So yeah, little shameless plug there, but it is a genuine question from Sheena. So thank you for that. What else are we saying? Limited companies. I know we touched on it briefly. Raj, I know, without giving away too many secrets to you, I know you've got a portfolio. Do you structure in limited? You buying your stuff in limited companies?
Yeah, or so I used to. My first couple of properties I bought was in personal name, and then I think from about 2019 I started doing a company when that became quite big and became the thing to do. But yeah, I think that's quite common for most landlords now. Even when we're as a letting agent and the landlords that we're dealing with, if they've got more than one, two properties, they tend to be in a limited company name, and I think there's just a lot of benefits for having it in a limited company. Obviously, you've got the tax, and then there's just other ways if you've got like a trading business as well, rather than taking a dividend out and then lending that to the company, you can do like intercompany loans from one company to the other, and it saves on tax that way. So there's quite a lot of benefits from buying in a company.
Yeah. Yeah, I think you've nailed it really, because within interest you can claim interest rates back. As we said with Faye, it's easy to get you can easily set up a limited company. We can help that. 100 quid, bits of ID, very easy to run because it's quite basic. We do work with third party accountants. We are looking at bringing that advice in-house. We might have a separate offshoot to help people and do maybe some kind of monthly management for those that don't want to get involved or don't want to get involved in the accounts. But capital gains, you're exempt from inheritance tax. So if you're succession planning, I think is really important to look at that. When you sell a property, you're selling the limited company. So for the incoming investor, there's no stamp duty. You're going to have to pay stamp duty, unfortunately, but for the incoming investor, we've seen it where some people are selling portfolios if they've reached a certain age. Again, it varies, doesn't it, by individual clients. So again, we can help sort of point you in the right direction depending on your personal circumstance. Because if you're overseas, you've got, what is it, 12,500 sort of tax-free allowance. So if you're just buying one property, and it's maybe a husband doesn't work or a wife doesn't work. Again, everyone's circumstances are different, so might not be right for everyone. But what you're saying, Faye, are you seeing 50, 60, 70% of people at the moment buying in limited companies?
Yeah, I'd say so. Yeah, I'd probably even more. I'd probably say 80 plus. I think most of it is that you can offset the interest.
That's the big thing, isn't
It
it?
is. It's money in your pocket, and not only that, for future planning. So, a lot of people, they might not need the money now. So it sits in a limited company. They don't pay tax on it, but because they're higher rate taxpayers now. But when they get into, and I'm not a tax advisor by the way, so it's just what I'm
Yeah.
saying. But when they get into retirement age and they stop working, all that money is sat in the limited company. They could draw the 12,570 out tax free and then dividends. So it's more future planning. So again, my properties I've got personal before the limited companies all
Yes.
came
Yeah.
around. Can't move them. Well, I can move them, but I don't want to pay all the stamp duty. And now I've got them in the limited company. So it's just best of both worlds. I think buying in a personal name, if you want to sell the property and live off a lump sum of the capital growth, that's fine. but again, you're going to pay more tax up until you sell it. Limited company is the opposite. So yeah, I would definitely, unless somebody wants to live in that property or use it for future, then most people are doing it in a limited company now.
Yeah, most of I think our clients are investing in limited companies, and I've got here just a quote. It says a record 66,587 new buy-to-let companies were set up in 2025, up 8% in a year, 363% over the last decade, making it the second most common new business type in the UK, behind only online retail business. So what I say, it says here, what's going on? Why is people saying buy to let's dead? It's
Yeah,
not.
no.
It's, the press are a bit of a nightmare. Yes, look, you've got taxes, but again, with a limited company structure, you can be clever with the mortgage rates at 2.7. I've got stuff at the moment where I can show you, and this was on a 4% rate. I can show you stuff at the moment for £160,000 off plan. You're 800 at the higher rate, £850 a month net. That's after stamp duty, furnishings, legal fees, management fees, lettings fees, £850 a month cash flow positive. Um, Also, I think on that note, we see you've got BlackRock. We've met with them. They're a big institutional investor. They've got 420, not million, 420 billion of property assets invested worldwide, and they're coming into the UK. They're BTR, build to rent developer. What does that mean? Well, it means they're doing potentially what our audience here is looking to do. But they're not just they're building or buying whole developments build to rent. They're building them, keeping them there, renting them out because they know for their institutional shareholders, it's as safe as houses. They're getting the capital appreciation ultimately when they want to exit, and of course they're getting those strong rental yields because, as we said earlier, it's a rental world. So you've got Lloyds Bank, one of the insurance companies. They're using, if it's Lloyds Bank and you're investing with Lloyds, they're using your money to do what you're looking to do. Why? Because BlackRock was saying that the UK is undervalued. So they see, as we all do, if you look at your JLLs, your Knight Franks, and your Savills, on average, in key areas, you're looking at 25% capital appreciation between now and the end of the decade, which is only 4 or 5, sounds a long way away, but it's only sort of 4 or 5 years away. So the fundamentals are there with capital appreciation and rental yields. We find a lot of people procrastinate, which is fine. I can remember buying, everyone thinks there's going to be a crash, never has. I'll caveat that with maybe 2007, 2008. I bought at the top of the market. All my mates took the mickey out of me. But guess what? What I bought dropped 5%, but I didn't need to sell it. And those property prices have doubled, trebled in value since then. So if you're in it for the long haul, because we have Trump, Truss, COVID, Ukraine, people don't say, "Oh my God, there's a war in Ukraine. I'll go and live in a tent." No one's moving out. That the buy to let model is here to stay. So yeah, so it's about being brave and, as I say, being in it for the long haul, really. Um, Anything else? We've got any more questions coming in? I've been sort of bouncing around, covering a few other bits and bobs. Limited company, we can help there. Anything, Raj, from a sort of compliance? Is it more hassle? Is there more? Yeah, I suppose you take away all the work from a lettings agent, but anything else a landlord should be wary of at the moment?
Not really. I think in terms of renters' rights, I think if a landlord's using an agent, they don't really need to think about it. There is more, adapting to new processes and kind of different things we need to do now. But that's not the landlord's problem to worry about. That's our problem as the agent. So yeah, I wouldn't, and it's only something if a landlord's self-managing, they need to be kind of more aware of stuff. That there is something coming into play maybe towards the end of the year or next year where landlords will have to be a member of an ombudsman scheme. So at the moment, tenants can complain about the agent to the ombudsman and not the landlord. But there's going to be something introduced where they can also complain about the landlord. But again, if you're a good landlord and you're doing things properly and you dealing with your maintenance issues, then you've got nothing to worry about.
And again, with a good agent, you'll take that headache away because you're managing it. So
Mm.
I suppose if there is a complaint, it's probably more aimed at at you
Yeah, yeah. I
because
think
you're
that
doing all the management.
I
So
think the
you,
reason for the ombudsman scheme is tenants that are dealing directly with a landlord and there's no agent involved. They've got
right,
nowhere to go.
yeah,
We
yeah,
had
makes sense.
um we had one today, which is brilliant, where they took a photo of the property and they'd AI generated a smoke alarm in there because there wasn't a smoke alarm. It's like a
Really,
smoke alarm's like 20 quid. So and that is why, the new tenancy scheme is there's bad landlords out there, but obviously it's to stop that. But yeah, there was no smoke alarm in there and the AI generated one in there. Brilliant.
wow,
So yeah.
amazing. I mean, there are, as we all know, you know, there's a lot of rules and regs. A lot of it makes sense. It is to protect sort of all parties, I think. And again, I with Section 21, and you've got now Section 8, which is that does that give better protection, would you say now, to the landlord, Raj? In terms of
Um,
if there are any problem tenants?
Not, I'd probably say it's more. So Section 21, essentially, you could give notice to your tenant for any reason. Uh, Section 8, you could only give notice for certain reasons. So it's just a bit more restrictive for the landlord. But the reasons are the main reasons that as a landlord you'd want to give notice to your tenant, i.e., you're moving back into the property, you're selling, tenants in rent arrears, all the main reasons. They're the three biggest reasons why you'd want to get rid of your tenant. You know, the reason what you could do before, i.e., I don't like the tenants, so I just want to get rid of them. Can't do that anymore. But I can understand why you can't do that anymore. It probably wasn't the right thing that you can just give
Yeah.
for absolutely any reason. Now you can just do it for valid reasons.
And again, coming back to you, Raj, it's probably quite important. You do the credit checking and all the vetting, and that's everything is done up front. And I think you can get landlord insurance. I've never done it,
Yeah,
but you can have landlord, so you can sort of protect yourself against that, can't you?
yeah. So you can have like rent protection insurance where, if the tenant defaults, then you are essentially covered in terms of your rent will be paid by the insurer. Something that we do, which is one of our USPs, is every tenant that we put in a property, we offer free eviction cover. So if the tenant was to default and needed evicting, all your legal fees are covered. Um,
Brilliant.
so yeah, that's just something that we do as a kind
Nice.
of with it built in within our service.
We do. I know a lot of people talk SA or STL, serviced accommodation, and short-term lets. And we do have, funnily enough, the carbon homes. I'm waiting for a proposal to come through from a short-term letting provider. Now, short, where we've worked in other areas, like in the Midlands, it's a short-term let, like an Airbnb. However, they have a lot of corporate tenants that sign up for 12. They've been signed up for 12 and 15 months. So you don't have to worry about renters reform. It's a short term, it's considered a short term let, so none of these rules and regs apply. But you've got the knowledge that they've committed to 12 months or 15 months. So again, we've got, something for everyone really, depending if you've got any concerns. And we're starting, as I say, price wise, probably from £100,000 upwards, and the stuff at 150 has got this sort of stage payment term. So there's various options there. I'm mindful of the fact that we've done nearly an hour. I can't see any more questions unless anyone's got anything specific. Anything I've missed, Faye, on mortgages? Anything that we think is that comes up regularly?
Um, No, I think I am going to start doing like a frequently asked questions flyer as well. So when the clients have, a chat with me, some people have got experience in mortgages, some haven't, some have a lot of questions, some don't. So, we could share that out. So frequently asked questions that I do see a lot, we can send out to guys, because yeah, some people are afraid to ask the questions. That's what we're here for. You need to ask those questions to make sure you understand everything. So yeah, I could probably get that out. But no, apart from that, it'd be interesting to see at the end of the year where we are with rates, and hopefully everything is just improving and just getting better and better.
Brilliant, thanks. And Raj, anything on your side? I know, as you say, the rents have increased, but they're still, well, from what we're seeing, 2, 3, 4% increase per annum. I don't know if that's changed in the first half of this year much.
Yeah, that's probably about right. Obviously, you find because the lettings market goes a lot busier during the summer, so you find the rents particularly start increasing more in the summer months than kind of the low season in the winter. But yeah, probably about 3-4% is probably where they're at.
Lovely. I don't think there's any more questions unless anyone's got anything. Hannah, if you're there, do you want to see if the little poll questionnaire will come up?
Yeah, of course.
Thank you very much. Thanks, Hannah, for doing the slides.
Wow.
There's not too many slides tonight, so you've had an easy night. It's hot. So basically, tick one of the boxes. Free property consultation. And that's if you want to talk anything. We haven't really talked about property. That's the easy bit, really. It's the maths and the structuring and the rentals and everything that's behind it. We've got, I don't know, 4 or 5 key developments and developers we're working with. So we'll have something for you, depending on budgets and what you're looking to do in the short, mid, long term. So tick a box for a consultation. If you want to talk more about the rental side of things, tick the box, and ourselves or Raj will be in touch, or one of his team. And obviously, Faye, if you want a sort of mortgage consultation, if you've got something that's coming up. What we're saying, if we've got fixed rates, if someone's got something with a fixed rate coming up, should they be looking 6 months before, 3 months before?
Say 3 months, because then we can compare it against your current lender. That's when they open their rates. But they are quite tactical because they know a remortgage can usually take 3 months to move to another lender. So they get a bit time pressured. They want to keep you. So we could always have a look at, 3 to 4 months before, and then wait till they release their rates, and then you know what you're doing. But yeah, we can have a look at it for you and release equity to invest if you want to do so, or even if you just want a like-for-like remortgage.
And that one I did with Paul that I said was 7.9 down to 3.9. It was something like we got it all agreed, and I did give him plenty of notice, and we were something like 4.2, and we'd agreed that, but it came down.
Yeah.
So we were, if things change, obviously, if it went up, I'm protected because I'm locked in at that. So lots of things with the right help and support, lots of things you can do. So tick one of the boxes there, and we'll be in touch, and we can spend more time with you one-to-one going through anything in more detail. So I think that's it from me. Just want to say thanks, Faye. Thanks, Raj. Raj, you've probably got a bit of football on. Faye, you into the football?
I am, yeah, but now I'm going to be working. So yeah, I'm going to keep going, workaholic. So now I won't be watching the football tonight.
Brilliant. Listen, thanks everybody, and speak to you all soon.
Brilliant. Thank you very much.
Thanks a lot.
Thanks,
Take
guys.
care.
Take
Bye-bye.
care. Bye-bye.
Bye.